36 hours. That is the window in which Japan executed a financial maneuver that will be studied in strategic finance courses for the next generation. $94 billion moved with surgical precision, repositioned through mechanisms that most financial journalists do not have the technical vocabulary to describe accurately, achieving strategic effects that a conventional military operation could not have accomplished at any price. The word betrayal in this title will bother some viewers. It is the precise word. Not because Japan acted with malice toward its American security partner, but because the $94 billion move represents a deliberate decision to prioritize Japanese national economic interests over American strategic preferences in a moment when American policymakers were counting on Japanese institutional loyalty to buffer the consequence of their own policy decisions. That is, by any reasonable definition, a betrayal of the expectations that American strategic planners had built their models around. And here is what makes this story genuinely extraordinary. The mechanism Japan used was one that Americans taught them. The financial architecture that made this maneuver possible was built, refined, and recommended by American financial institutions, American economists, and American policy advisors over the course of 30 years. Japan used the tools of American financial sophistication to execute a pivot that American financial interests are not prepared for. I want to walk you through exactly how this happened. Not the diplomatic surface, not the press conference language about enduring partnerships and shared democratic values. The actual mechanism, the precise financial architecture, the specific numbers and what they mean. Because when you understand what Japan actually did in those 36 hours, you will understand something fundamental about the structural fragility of American financial hegemony that the news cycle is, as usual, completely missing. To understand the $94 billion move, you need to understand the relationship it disrupted. Japan is the largest foreign holder of American Treasury securities. Not one of the largest at $128 trillion in American Treasury holdings as of early 2025. Japan's institutional commitment to American sovereign debt represents the single most important bilateral financial relationship in the global Treasury market. That relationship was not accidental or sentimental. It was built on a specific economic logic that held for approximately 3 decades and then began to unravel in 2022. The logic was this: Japan's export-driven economy benefited from a weak yen relative to the dollar. A weak yen made Japanese exports price competitive in American markets and throughout Asia. Maintaining yen weakness required that Japan's central bank, the Bank of Japan, keep domestic interest rates extraordinarily low, effectively at or near zero for most of the past 2 decades. Low Japanese rates meant that Japanese institutional investors seeking yield that was unavailable domestically invested heavily in higher-yielding foreign assets, principally American Treasury securities. Japan's Treasury holdings were, in this sense, a structural byproduct of its own monetary policy architecture rather than a deliberate strategic choice. That logic collapsed when American interest rates rose sharply from 2022 onward. As the Federal Reserve raised its benchmark rate from near zero to over 5%, the interest rate differential between American and Japanese assets became extreme, the largest in the post-war period. This created the yen carry trade at unprecedented scale. Investors borrowed in low-rate yen, converted to dollars, and purchased high-yielding American assets, generating profits from the interest rate differential. The mechanism drove yen weakness beyond any level Japanese exporters required and into territory that was actively damaging Japanese consumers and Japanese import-dependent industries. The Bank of Japan had a choice. It could maintain its low-rate policy and watch the yen depreciate further with all the domestic economic damage that implied. Or it could begin raising rates, which would strengthen the yen, reduce the attractiveness of the carry trade, and, critically, incentivize Japanese institutional investors to repatriate capital from foreign assets back into domestic Japanese bonds, offering newly competitive yields. The Bank of Japan chose to raise rates, and that decision, while entirely logical from a Japanese domestic economic perspective, had implications for American Treasury markets that American policymakers had been warning about in private for 2 years before it happened. The 36-hour window opened at the Bank of Japan's policy meeting in March 2025. The specific decision announced was a rate increase of 25 basis points, bringing the Bank of Japan's benchmark rate to 0. 75%. In isolation, this is a modest adjustment. In the context of the financial architecture that had built up around the yen carry trade, it was the equivalent of removing the structural support from a building that had been load-bearing for a decade. Within 6 hours of the announcement, the mechanism triggered automatically and at scale. Japanese life insurance companies Nippon Life, Dai-ichi Life, Meiji Yasuda hold combined foreign bond portfolios of approximately $340 billion. Their internal risk management protocols, updated following previous yen volatility episodes, include automatic hedging triggers that activate when the Bank of Japan signals a sustained rate trajectory. When the March announcement was read as the beginning of a normalization cycle, rather than a one-time adjustment, those triggers activated. The hedging mechanism works as follows. A Japanese insurance company holding American Treasury securities has currency exposure. If the yen strengthens, the dollar value of those American assets translates into fewer yen when repatriated. To manage this currency risk, the company purchases yen forward contracts, effectively locking in a future exchange rate. When yen forward contracts are purchased at scale and Japanese institutional investors doing this simultaneously represents enormous scale. It creates demand for yen in the forward market that drives the spot yen exchange rate higher immediately, because forward and spot markets are linked through arbitrage relationships. $94 billion is the net notional value of the yen forward positions established by Japanese institutional investors in the 36 hours following the Bank of Japan announcement. This is not capital that left America. American Treasury bonds remained on Japanese balance sheets. What moved was the currency protection, the financial instrument that determines whether Japanese investors have an incentive to maintain or reduce their American holdings going forward. By establishing $94 billion in yen forward protection, Japanese institutions simultaneously protected themselves against yen appreciation and, crucially, reduced the financial penalty they would face if they chose to sell American treasuries and repatriate the proceeds into strengthening yen. Think about what that means in strategic terms. Before the 36-hour move, Japanese institutional investors faced a structural disincentive to sell American treasuries. A stronger yen would mean receiving fewer yen for their dollar assets, creating a realized loss on currency translation. After the 36-hour move, that disincentive was hedged away. The $94 billion position effectively made the option to exit American treasuries financially neutral or even attractive, depending on subsequent yen movement. Japan did not sell American assets. It removed the financial mechanism that had been keeping it from selling American assets. That is a strategically decisive difference. The Federal Reserve's Treasury market stability framework has a structural vulnerability that is well understood within the institution and rarely discussed publicly. That vulnerability is what analysts at the Bank for International Settlements have described as concentrated foreign official holdings. In plain language, when the largest foreign holder of American Treasury securities has a financial incentive to sell, it creates a price dynamic in the world's most important bond market that the Federal Reserve cannot easily offset through conventional policy instruments. $1.128 trillion in Japanese Treasury holdings represents approximately 4. 7% of total outstanding American public debt. This does not sound alarming in isolation. The alarm is in the trigger mechanism, because Japanese institutional investors are not a monolithic block that makes coordinated decisions. They are dozens of independent companies and institutions that each make independent decisions based on the same underlying financial conditions. When those conditions change, when the Bank of Japan's rate trajectory changes, when yen forward contract costs change, when domestic Japanese bond yields become competitive, they all receive the same signal simultaneously and respond in the same direction simultaneously. This is what financial analysts call a correlated exit risk. It means that the probability that Japanese holdings decrease is not independent across the different holders. They move together because they respond to the same underlying conditions. $1.128 trillion in correlated exit risk is, according to analysis published by the Peterson Institute for International Economics in January 2025, the single largest identifiable systemic risk to American Treasury market functioning that is not under Federal Reserve control. The $94 billion hedging move increased the probability of that correlated exit materializing, not to certainty, but measurably, and measurably in a direction that changes the Treasury market's risk profile in ways that affect every American who has a mortgage, a pension, or a savings account. Here is how it reaches you. When the probability of a major foreign holder reducing Treasury exposure increases, the risk premium that other investors demand to hold American Treasuries increases. Risk premiums in the Treasury market show up as higher yields. Higher Treasury yields are the benchmark from which American mortgage rates, corporate borrowing rates, and consumer loan rates are priced. A 25 basis point increase in Treasury yields, the kind of modest repricing that a credible threat of Japanese selling can produce without any actual selling occurring, adds approximately $47 per month to the cost of a $300,000 30-year mortgage. Across the 2 million new mortgage originations that American lenders process annually. That is a $6 billion annual cost increase distributed across American households. That is not a number from a geopolitical analysis. That is a housing market consequence. That is the kitchen table impact of a 36-hour financial maneuver executed in Tokyo. The mechanism Japan has deployed is historically unprecedented in its specific form, but structurally familiar to anyone who has studied how financial leverage erodes in reserve currency systems. In the late 1950s and early 1960s, Britain faced a structurally analogous situation. Sterling area countries, nations that held their reserves in British pounds and conducted trade denominated in sterling, had gradually accumulated the financial sophistication to perceive that sterling's value was declining relative to its reserve currency function. The specific mechanism was different. It involved sterling balances in London rather than Treasury holdings in Washington. But the strategic logic was identical. Countries that had been structural buyers and holders of British financial assets began, one by one, hedging their exposure and reducing their holdings. Not because they were hostile to Britain, because their own financial interests made that adjustment rational. Britain's response was to attempt bilateral negotiations, currency swap arrangements, and ultimately emergency international monetary fund financing. None of these measures address the underlying structural reality. Sterling's reserve currency role depended on confidence in British economic management and British geopolitical stability, and that confidence had eroded to a point where the financial mathematics of holding sterling assets no longer justified the risks. The pound did not collapse in a day. It was degraded over a decade of accumulated adjustments, each individually manageable, collectively transformative. The American dollar is not at that point. American financial primacy remains the organizing principle of global finance. But Japan's $94 billion move is the kind of structural hedge adjustment that, when studied in retrospect, historians identify as the moment when a reserve currency system's participants began treating its primacy as a variable rather than a constant. Consider the implications carefully. When financial actors treat reserve currency status as a variable that can be hedged against, the hedging itself generates the outcomes they are hedging against. It is a self-fulfilling mechanism with no equilibrium until a new reserve architecture emerges. Britain did not choose to lose sterling's reserve role. It was lost incrementally by rational actors, each making individually rational decisions. You may have noticed that this analysis has proceeded through 4 chapters without explaining how China is specifically implicated. That omission is deliberate. China's role in the Japan story is not active. It is structural, and structural roles are more durable than active ones. Japan's pivot, expressed through the $94 billion hedging move, was driven by Japanese domestic economic conditions: yen weakness, import cost pressure, demographic challenges requiring higher domestic investment returns. China did not cause these conditions, but China benefits from them through mechanisms that deserve precise identification. First, the yen carry trade unwind that Japan's rate normalization is triggering reduces the structural demand for dollar assets that has been one of the primary supports for dollar strength. Dollar strength is an American asset. Reduced structural demand for dollars affects the exchange rate at which China manages its own currency and reduces the relative cost of Chinese goods in global markets. A weaker dollar environment is a more competitive environment for Chinese manufacturing. Second, Japanese institutional investors repatriating capital from American treasuries need to redeploy that capital somewhere. The options include domestic Japanese bonds, newly attractive at higher rates, and alternative foreign assets in markets offering competitive yields and diversification. Chinese government bonds, included in major international bond indices since 2019, represent one of the few markets of sufficient scale and liquidity to absorb repatriated Japanese capital. A reallocation of even 10% of the potential Japanese Treasury reduction, roughly $110 billion, into Chinese sovereign debt would be the largest single capital inflow in Chinese bond market history. Third, and most consequentially, every financial actor globally that is watching Japan's 36-hour maneuver is updating its own risk model for American Treasury concentration. The sovereign wealth funds, the central bank reserve managers, the pension fund committees of Norway, Singapore, South Korea, Saudi Arabia, and UAE are all observing the same structural dynamic and asking the same question. If Japan, America's closest and most loyal financial ally in Asia, has moved to hedge its American exposure, what does that imply about our own optimal allocation? China does not need to answer that question. It needs only to be present as an alternative when those actors begin looking for one. And it has spent 15 years ensuring that its financial markets are sufficiently developed to serve as a partial alternative for the most sophisticated global investors. Partial is enough. Partial is all that is needed to change the calculus. Japan did not betray the alliance. It did not cancel the security treaty. It did not stop buying American military aircraft or hosting American bases. The 7th Fleet still operates from Yokosuka. Japanese and American forces still conduct joint exercises. The alliance architecture remains intact. What was betrayed was the financial codependency that had been the economic foundation of the security relationship. The assumption, held implicitly by American policymakers, priced into American treasury markets, built into American fiscal planning, was that Japanese institutional loyalty to the alliance would translate into Japanese institutional tolerance for whatever risk conditions American assets presented. That assumption turned out to have a price, and when the Bank of Japan's policy adjustment made that price explicit, Japanese institutions responded as financial actors rather than as alliance members. This is rational. It is also, from the perspective of American strategic planning, a genuinely alarming development, because the financial codependency of alliance relationships has been one of the key mechanisms through which American foreign policy has been able to maintain costly security commitments without facing the full fiscal consequences. Allies who hold your debt have an incentive not to undermine your credit. Allies who hedge your debt have no such incentive. $94 billion in 36 hours tells you that the incentive has changed. And in Beijing, the response to this development is not triumphalism. It is patience. China has been building the institutional infrastructure to receive and deploy the capital that is slowly, structurally, and now demonstrably beginning to move away from American concentration. It has built the bond markets, the swap line arrangements, the bilateral currency agreements, and the diplomatic relationships that allow it to present itself as a viable destination for capital that is looking for alternatives. The $94 billion move did not transfer money to China. It transferred something more valuable than money. It transferred the financial world's perception of American Treasury assets from irreplaceable to replaceable, given sufficient preparation. That is the move that matters. Everything else is arithmetic.